What's up, family? Andre here. In an effort to continue to update and educate you on all things financial, today's episode is about a popular asset class, an instrument that a number of people are using, and that would be ETFs, otherwise known as exchange traded funds. But as always, before we get started, please don't forget to smash that like button, hit the subscriber button, as well as the bell next to it to get updated weekly content. ETFs have become increasingly popular over the last several years. Many people understand the benefits of investing in an ETF. But on today's episode, I'm going to break down exactly what is an ETF, the benefits, pros, and cons, as well as how it can impact you and your money. So first, what is an ETF? An ETF, or exchange traded fund, is a type of security that tracks either an index, sector, commodity, or other asset, and it can be purchased or sold on a stock exchange just like regular stock. ETFs can be structured to track anything. They can track anything from an individual price of a commodity to a large varied collection of securities. They can also be able to be structured to track particular investment strategies as well. ETFs can contain many different types of investments, from stocks, commodities, bonds, or other types of investments. It is a marketable security, which means it has a specific price, which allows it to be easily bought and sold. An ETF is called an exchange traded fund because it is traded on the exchange just like stocks. The prices of an ETF vary throughout the day as shares are bought and sold. This is unlike mutual funds, which are not traded on an exchange and are only traded once per day after the market closes. ETFs tend to be more cost-effective and liquid in comparison to their mutual fund counterparts. They also tend to be able to hold multiple assets instead of one particular asset, such as a stock. ETFs are very popular amongst clients and investors because you can hold multiple assets within the ETF. You can have real estate, you can have emerging markets, you can have other things even besides stocks within the ETF. It then allows for the person to become much more diversified, all within the same ETF. An ETF can own hundreds, if not thousands, of stocks within a particular ETF. It also can be very specific and only focus on one particular industry within that ETF. It also can become very diversified across a global outlook or be very focused on only domestic industries. There are a variety of types of ETFs that are available to investors. Some help generate income, others help to offset risk to a particular part of the investment portfolio. Here are a few different types of ETFs. Bond ETFs may focus on government as well as corporate and municipal bonds within the particular ETF. Industry ETFs that solely focus on a particular industry such as technology, banking, or energy. Commodity ETFs only invest in commodities within a particular ETF, such as crude oil, gold, or silver. Inverse ETFs attempt to gain value by benefiting on stock declines or shorting stocks. In the United States, most ETFs are set up as open-ended funds, and therefore they are subject to the Investment Company Act of 1940. Open-ended funds do not limit the number of investors that can be in a particular product. ETFs can be utilized through your traditional online brokers as well as your traditional broker-dealers. They also now are available through robo-advisors such as Betterment and Wealthfront that now have ETFs as a part of their investment strategy as well. Here are a few of the more popular ETFs that you may or may not be aware of that are being utilized in the marketplace today. The SPDR S&P 500, which tracks the S&P 500 index. It is the oldest surviving and most widely known ETF on the market today. The iShares Russell 2000 follows the Russell 2000 Small Cap Index. The Invesco QQQ follows the NASDAQ 100 and particularly focuses on technology stocks. The SPDR Dow Jones Industrial Average tracks the 30 stocks within the Dow Jones Industrial Average Index. Commodity ETFs represent specific commodities such as crude oil and natural gas. Physically backed ETFs are actual ETFs that hold physical gold and silver within their particular funds. ETFs typically offer the average investor lower average cost than if they owned all of the different multiple assets or stocks individually. They typically can be able to purchase an ETF once or sell it once, thus lowering any potential commissions that would occur as a result of any numerous transactions. The expense ratio associated with the ETF, which essentially is the cost of operating and managing a fund, is typically lower with the ETFs because they track an individual index. There are two different types of managed ETFs. You have actively managed ETFs and passively managed ETFs. An actively managed ETF is typically where the portfolio managers are much more involved and active in buying and selling shares of particular companies within that ETF. As a result, they typically have a higher expense ratio because of the active managed portion of the portfolio managers within that particular ETF. A passive managed ETF is just the opposite of active management. That typically is where the portfolio managers have more of a hands-off approach and are not actively involved in this particular ETF. They may review and make any adjustments on an annual or biannual basis. Therefore, the expense ratio on passively managed ETFs is significantly lower than actively managed. An index stock ETF provides investors with the diversification of an index fund with the ability to sell short, also to buy on margin, and purchase as little as one share within that ETF as there are no minimum deposit requirements. Although it is known just like individual stocks, ETFs provide the investor the ability to gain value within their portfolio as stock prices increase. But there's also the benefit of ETFs that can be able to provide the investor with companies that pay dividends also. Dividends are a portion of earnings that are allocated and paid to investors for simply holding a particular company's stock. ETF shareholders are entitled to a proportion of the profits, either through interest or dividends that are paid, and they also may see an increase in their value if and when the ETF is liquidated. An ETF is much more tax efficient than a traditional mutual fund, as an ETF does not need to redeem shares if and when an investor wants to buy or sell as you do with a traditional mutual fund. Redeeming shares of a particular fund can trigger a tax liability, but listing them on an exchange tends to lower that cost of the tax liability and provide favorable tax treatment for the investor. There have been many concerns and criticisms about the influence of ETFs on the market and their ability to inflate as well as deflate stock bubbles. Much of the concern and criticism is around that many ETFs rely on portfolio-based models that are untested in certain extreme market conditions, whether they're extreme bull market or extreme bear markets. And in those situations where there is significant inflows and outflows in those particular funds, it can have a dramatic effect on the markets themselves. If you take a look and examine the significant financial crashes over the last decade, you will see that ETFs played a major role in many of those flash crashes because of the significant inflows and outflows coming from ETFs. The supply of ETF shares is regulated through a mechanism called creation and redemption. This includes large specialized investors called authorized participants. When an ETF wants to issue additional shares of a particular index, the authorized participant goes and buys the shares of that particular index, which is also tracked by the fund, and then sells the shares of that particular index to the ETF for an equal value of those shares. The process of the authorized participant selling stocks to the ETF sponsor in return for shares in the ETF is called creation. Conversely, an authorized participant buys shares of an ETF on the open market. They then take those shares and sell them back to the ETF sponsor in return for individual shares of stock that now the AP can sell on the open market for a profit. This process is called redemption. The amount of redemption and creation activity is simply a function of the demand within the market and whether the ETF is trading at a discount or a premium to the value of the fund's assets. What are the key takeaways for ETFs? An exchange traded fund, or ETF, is a combination of securities that is traded on an exchange just like a stock. ETF's share price fluctuates all day as the ETF's shares are bought and sold, which is different than the way a mutual fund is traded. ETFs can contain all different types of investments, including stocks, bonds, commodities, or they can be focused in one particular area of the world, whether domestically or internationally. ETFs tend to be lower cost as they offer the investor a low-cost way to own a multitude of stocks with lower commission fees. ETFs, by providing the investor with a multitude of different asset classes to invest in, provides that investor with diversification. And that is it. Hopefully now you have a better understanding of exactly what exchange-traded funds, or ETFs, are, the different types of ETF funds that are out there, and how ETFs can have an impact on you and your money. Please don't forget to smash that like button, hit the subscriber button, as well as the bell next to it to get updated weekly content. Thank you so much for tuning in.